takes pleasure in attracting a stellar list of speakers that address today's most relevant issues. The club's place as a refuge for rich discussion and networking has never wavered after 123 seasons.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Hello, and thank you for joining us. My name is Anita McCourt, and I'm the president of the Canadian Club Toronto. The COVID-19 pandemic has upended world markets and injected unprecedented stress and volatility into the global economy. At the same time, investors have been forced to grapple with persistently low interest rates and sluggish investment returns. Where are institutional investors finding opportunity and value against this rapidly changing backdrop? Today, we're joined by Bert Clark, President and CEO of the Investment Management Corporation of Ontario, for an in-depth discussion about how their organization is managing more than $70 billion in public pension fund assets. Before we dive into today's topic, here's some information about how you can participate with us. If your video is slow, just click here to switch stream, and it should help. The video quality may decrease, but the audio will stay strong. If you have questions, just click the questions tab, enter your question in the window, and it will make its way to our moderator. This is a year unlike any other in our 124 years of operation at the Canadian Club. And our goal here continues to be to uphold our mission of connecting Canadians with the programming that matters most. We're proud to announce our 2020-2021 All Access Pass memberships, which will include free access to all of our programming for the season. To learn more about it and become a member, visit us at canadianclub.org today. Now to introduce today's speaker. Bert Clark is the President and CEO of IMCO, managing $70 billion of assets, and their mandate is to provide broader public sector institutions with investment management services. Today, Bert will be joined in conversation by Amanda Lang, anchor and reporter for BNN Bloomberg. One of the club's traditions that has not changed in this virtual world is the toast that we make to our country at the start of every event. Usually we do this in person, raising of a glass, but today we're just gonna grab a glass if you've got one, make a nod to the screen, and toast to Canada. To Canada. Canada. Amanda, I'll turn the Canadian Club podium over to you.
Well, thank you very much for that. And it is a great pleasure to be here and to be here with you, Bert, because these are definitely interesting times. And I think folks like you who are just not just spectators like the rest of us, but are really charged with trying to figure out what to do in this environment are people we really look to now. So thank you for this. And I will just reiterate that any questions that folks send in, I'll see them on the screen in front of me, and I'll incorporate them as we go along. So if any of our viewers have a question, don't be shy, send it in, and we'll get it right into the conversation. Bert, the place I want to start, I mean, obviously this has now been, we're sort of in, I guess, depending how you measure it, but we're certainly 6-7 months into a very strange set of circumstances. And I know that for funds like yours, there was an immediate reaction in the spring that you went through. I'd like to start with where you are now in terms of what you're doing differently because we're in the middle of a pandemic. And I mean, I guess both from an operational point of view as a business, but also what you're thinking about differently than you would have been, say, in February.
I guess operationally, we're still all at home. So we went home in mid-March, like many people, many organizations, and we're still all working from home and have been consistently through that whole 6-month period. Quite amazing to me, actually, how productive the organization has been throughout that. We are still achieving our corporate objectives, and that's in large part due to the hard work of everybody in our organization. In terms of investing, I'm a big believer in not changing your strategy as markets move around. We've had crises before, and so we stick to the things that the strategies we employ in good times and bad. That means maintaining diversity, liquidity, keeping costs down, targeting NVA in very targeted ways, and navigating big trends. So I'd say we haven't fundamentally changed our game plan, and I think people need to accept that markets do go up and down. This crisis feels different than others, but the GFC did too, and we're long-term investors, and we stick to our game plan.
You know, when this thing happened, and for a lot of us, it was really early March when we realized that this was going to be a devastating economic event, a lockdown like we've never seen before. The general response, and I think it was a credible one, was we don't know what's going to happen. So everybody abandoned forecasts. Economists said we're not sure. The government for sure said we don't know. And a lot of businesses said we can't give you an outlook for some time. We're starting to get to a place now where people are getting a handle on it because we do know what a full lockdown looked like. We can kind of scenario model. When you think about where we are, and I say this knowing full well that the uncertainty runs high, we don't know what's going to happen in the months ahead. Do you have a better handle on what it means to be in a pandemic when it comes to economic effects?
Well, I think, we're all coming to accept the fact that this is going to be a serious recession, that we're not going to have a V-shaped recovery. When we invest, we tend not to, though, invest on a short-term basis. And so even before this crisis, we were thinking about long-term trends. And one of the more powerful trends that frankly hasn't been improved by COVID-19 is lower returns across all asset classes. Over the last decade, it was almost hard to mess up. Almost every asset class performed well. Equities, infrastructure, real estate, even bonds. With declining rates, you saw huge appreciation. Before the crisis, looking out the next 10 years, we assumed that returns are going to be lower across all asset classes. And obviously COVID hasn't helped. I'd say there's a couple of other trends that have been reinforced by COVID if you're a long-term investor that we have our eyes on. The first of those is the role of the central banks in markets. 10 or 15 years ago, central banks met privately. They issued statements. People pored over the statements for days trying to figure out what exactly they meant. And they intervened very little in markets, mostly at the short end of the curve. Today, central banks are playing a role unlike they've ever played in the markets before. They tell you where rates are going to be for 3 years across the curve. They have balance sheets that are bigger than BlackRock and Vanguard. And that's that is one of the big challenges, I think, of the coming years, navigating that government presence in the market.
I want to drill down into that because I do feel like that's one of those things where, most of the time, most people can ignore what central banks are up to. This is a time in history where, actually everybody needs to really understand a little bit about this. But I want to back up to your first point, which is that long-term trend on asset returns, because this is one, and Bert, there are aspects of this that are also kind of social and political, right? Where we highlight the inequities between people who are savers and people who are borrowers. For a fund like yours, though, you really are kind of like, my grandmother writ large, right? You have to match up what you have against the obligations. It has to last the lifetime, for my grandmother of her life, for you, of your liabilities. And that's been harder and harder. So just give me your mindset of the risk. There was a time when you could buy, pretty safe bonds and lock in a rate of return that would give you what you needed to meet those obligations. That hasn't been true for a while.
You're absolutely right. I mean, we've had a secular bull market in bonds, which is a fancy way of saying interest rates have been declining for 35 years, and that's been great for owners of bonds because not only are you earning returns, but you're seeing capital appreciation. It's hard to imagine how we have that same thing go on for another 20 years with us sitting where we are in terms of interest rates. There are another couple of powerful trends that also are going to weigh on returns over the next 10 years. All of the largest economies are aging, and that makes for slower growth. And all of the largest economies have been growing in terms of their indebtedness, and that makes for slower growth. And as I said, all those things were true coming into COVID, and COVID's made us more indebted and starting the next decade in a recession. And so, when we look forward, we don't view that as changing. That's only been reinforced. I think investors have to accept that if you're in a lower return environment, you're going to earn lower returns generally. Just as they enjoyed the benefits of 10 years of strong growth in all asset classes. And I think they have to avoid looking or thinking that there is a silver bullet here to navigate or avoid that, and come back to those core investment strategies that do tend to produce better results over the long term. And to repeat that, for us, that's not making big asset class bets. You can't afford to get those wrong these days. Getting your costs down. Costs really do matter. And in the asset management industry, the vast majority of the cost structures and fee structures were developed years ago when projected returns were higher, and haven't changed at all. So you need to do things to get costs down. You need to have enough liquidity. It sounds obvious, but every time there's a crisis, there's one or two large institutions that find themselves caught between the bases. And so you need to have liquidity. You need to be very targeted in how you try to outperform. The asset management industry on the whole has a bad track record of outperforming. It's really hard to do. And so investors need to avoid the temptation of trying to outperform in all places at all times, and focus on the places where they actually have an advantage.
Have you made investments that were COVID specific? In other words, did you change any strategy or invest in anything particularly because we're in the middle of this pandemic?
Yeah, I mean, there's two things. As I said, targeted. You need to be very targeted where you pursue net value add, and one of the areas we think will be quite promising over the next couple of years is credit. The corporations are more indebted. Banks, frankly, since the global financial crisis, have withdrawn to some extent as lenders, and certainly in some markets. And COVID has had a really intense impact on some businesses, and so we think there are real opportunities. We partner with a number of specialist credit investors to pursue opportunities in lending and balance sheet restructurings.
I want to go, actually, I'm getting a question here from a viewer that's almost at the other end of the spectrum. But one of the things that we've seen is a real massive inflow of new investors, Robinhood, kind of the line on it, and I don't know how serious this was, Bert, but the line was, people can't go to the track. And this is their outlet for their kind of gambling and betting mentality. What we do know, the data is there, is that there's a big retail surge through some of these online platforms. New investors in this market, and of course they're investing in a rising market. Must feel fun. What would your advice be to somebody who isn't an investor, has not been in the market, and is thinking, should I start now? Is this the time to get in?
I'd say, the best advice is, if you're getting into the markets, do it gradually. Almost nobody has been able to time markets, and maybe this summer was the right time, but the best strategy tends to be to go in very gradually over time. And for an unsophisticated investor, someone who doesn't have the scale that we do to really study and pick stocks, I'd be using an index. The average retail investor is not going to have the sorts of market insights that's going to allow them to outperform. So I'd be very, as I say, I'd be very careful about getting in all at once, and I'd be very careful about getting into one individual stock all at once.
When we think of indexes, of course, they are not all created equal. Which certainly the S&P 500 has done much better than, say, the Toronto Stock Exchange, the broad Canadian market. Given this is just kind of a broader question about Canada and the economic landscape here, but really our market is very energy heavy. Energy and financial are kind of the big weights on our index, while in the US it'll be those 5 big tech names. Does that make Canada a place to shy away from when there's additional uncertainty about the future of the energy sector?
Well, I'm a proud Canadian and a strong believer in the future health of our economy. I'd say for investors like us, though, we try and build globally diversified portfolios. And when you look at the size of the Canadian market cap relative to global market capitalization, most institutional investors probably ought to have less Canadian exposure, not because not any reflection on a view on Canada, but just it's a small part of the global landscape. And if you're building a diversified portfolio, it's going to be a smaller part of it.
Go ahead.
Just say a thing on indexes, because one of the amazing things to me about where we're sitting today is, you mentioned the S&P, we're up year to date, and we're sitting in the middle of a pandemic at home. Businesses are being shut down. There's an outbreak of COVID in the White House, and yet the S&P is up. How does that all make sense? Again, it comes back to that, really unusually large role of the central banks in the markets. They've been pumping trillions of dollars into the markets, and that finds its way into inflating all assets. I think though, if you go below the index, one of the other very interesting things is there's been massive dispersion of results. And so that, COVID has created really big winners and big losers. And the difference between the top performing stocks and the bottom is huge.
Yeah.
And that again is, makes for a trickier market, but it also does create the sorts of opportunities that we're looking for.
And obviously that disconnect have been on the minds of many, right? That there's this sort of, in some ways, the stock market feels to me a bit like, Marie Antoinette, let them eat cake if they can't get bread. Yes, you've lost your job, but look at your investment portfolio. And yet it doesn't feel like a real reflection. There's a lot of talk about the unevenness of the recovery, that the pandemic was uneven in its devastation, and that the recovery will also be uneven. K-shaped is the letter that people are using. Some people will do extremely well, other people will do extremely poorly. Does that change your thinking about investing? Are there some investments you would stay away from because of that K-shaped, or does it affect investors at all?
I think that is one of the big challenges, that wide dispersion of results. Wide dispersion of results makes markets more risky, but it also does create opportunities. If everything is earning about the same, it's hard to outperform, and that is one of the places we think there will be opportunities. I think there will be businesses whose fundamentals are not as beat up as their stock or values would suggest today, and that is one of the things we are pursuing along with a number of our partners. I do think for the last 15 years, 10 or 15 years, though, there has been this sort of divergence between, the markets and the economy. They're never perfectly related, but 10 years ago, the total U.S. market was about the same size as GDP, annual GDP, and today it's about 150% of GDP. Right. That reflects that ongoing involvement by the central banks in pushing money into the markets.
And let's just talk for a second about the central banks, because again, for most people, most of the time, you can happily ignore what the central bank is up to, as long as they're doing what they've been doing for the last couple of decades, which is maintaining that band of inflation. Now we have this massive monetary stimulus. It's kind of a global experiment in what happens when we all pump as much money as we possibly can into the system. And so because we've never done it before, I'm not going to ask you to forecast exactly what's going to happen, but what do you worry about on the other side of this? There has to be another side. So far the answer to too much monetary stimulus has been more monetary stimulus. So my question is, at some point, surely the music stops. And what does that look like?
I think you're absolutely right. I think central banks have been trying to solve that problem of lower for longer, lower growth because of aging populations and debt by driving rates lower. And it certainly had the effect of keeping market prices up and keeping the markets frothy. But I'm not sure it's addressed that underlying issue, which is slowing long-term growth. I'll tell you what I do worry about. That large involvement by central banks in the markets creates a big risk. We are all now reliant on the central banks to stay there. None of our portfolios could afford to have them withdraw. Right. And when you're all dependent on one thing and it's the government, that makes me nervous as an investor. I'd say there's no market, whether it's an electricity market, a commodity market, or a capital market, that over the long term works really well when there's a lot of government intervention. So I worry about that. And then the thing that we are spending a lot of time on, and I think a lot of institutional investors are spending time on, which is when central banks drive interest rates down to so that the yields on bonds are negative in real terms. How do you build a balanced portfolio when in the old days, you had a 60-40, when 40% of your portfolio is yielding negative real rates. This creates a real challenge for institutional investors.
A challenge that, as you said, predates this period of time, but it's certainly going to be exacerbated as we now head into negative territory. We've seen it's drawn some into riskier places. Equities are obviously the most risky place. High yield bonds, we've seen a lot of concern about parts of the bond market that got a little light on covenants towards the end of 2019. What's your concern about that, about the biggest players in the world? And I know you guys with tons of capital you can do private investments, you can do infrastructure, you can do things that are kind of stable by nature and long term. But I imagine even there, your yields drop in this environment.
It does. So, 15 or 20 years ago, your typical investor did have, 60-40 or some version of it. And most institutional investors have drifted away from that, from 60-40 to 70-30 to 80-20. And so they're moving into portfolios that are much more risky. Ultimately, bonds play a few roles for institutional investors. They generate yield. They provide liquidity, and they provide diversification. When things go badly in the risk markets, bonds tend to rise in value. All of those things they do less well today than they did in the past. We talked about the fact that they used to provide a return inflation plus something. Today they provide a return of inflation minus something. We've also had some incidents recently where they didn't provide the diversification. They didn't jump in value when stocks dropped. And so they still provide liquidity, though. I'd say that they pretty reliably do. But being, more than 80% risk assets is probably not a place most investors will be comfortable with. That they won't have the liquidity and, frankly, the volatility of that portfolio. I guess I'd like to tell you we have a solution today for what you do about that. We don't, but I can tell you that it is one of the things we're spending all kinds of time on is, well, if the answer is not to go from 80% risk assets to 90%, how do we deal with this problem of low yielding bonds?
And do that at the same time that everybody else in your business is doing the same thing. So kind of all competing for the same stuff. How hard is that?
Well, that is why, when you push money into bonds, it ultimately pushes up the price of everything else. And so, the multiples on equity have gone up, and the spreads on credit have come down. That liquidity, ultimately, everything prices off of the risk-free rate, and everything's been pushed up in value, which brings you back to everything's likely going to yield lower going forward.
One of the things we've seen, of course, when you don't get any return anywhere, gold suddenly gets very attractive for a couple of different reasons. But what's your view of gold and its sort of attractiveness as an investment, or just a store of value in these times?
So none of our clients are big investors in gold directly as a commodity or asset. They'd obviously have gold exposure through listed equities, but it wouldn't be a material part of their portfolio. Gold tends to, as you say, be a store of value. It can also be a protection against inflation. And so in periods of, quickly changing inflation or crisis where people are rushing to safety, it performs pretty reliably. But over the long term, it doesn't generate a return, and its correlation to other assets is not as reliable. And so it's a hard thing to build into your portfolio as a big allocation and know what it's going to do over the long term. You'll know what it'll do in these brief periods, but over the long term, it's not all that predictable. So it's not something we would recommend that our clients hold in large allocations.
There is a question from a viewer about cryptocurrency. And normally I would treat this as kind of like, an interesting little, but I don't know if you saw the news that Square, the payments processing company, has made a not immaterial investment in Bitcoin today, and says that they believe it'll be kind of a serious player in the currency space at some point. At some point seems to be, of course, the sort of thing we think about Bitcoin. But it is a kind of a legitimizing of this part of the market that's felt a little bit weird. Do you feel there's a coming of age for this? Will there be a moment when we're all talking about it? Because it felt like it was going to happen 2 years ago, and then nothing's happened since.
I mean, I think that blockchain as a technology is here. I think it's going to grow in importance. It wouldn't surprise me at some point if you did have some, widely accepted form of digital currency. You heard, the Bank of England was talking about that, as you were referring to, I think, a couple of years ago, that this was something, worthy of serious study. For us, it feels too early to be jumping in, that there isn't a established dominant currency, and the regulatory environment is just way too uncertain for us. Yeah.
I got a question from a viewer about your view of commercial real estate valuations. Lots of questions, Bert, and I know this goes to your own business and what you're doing. But office, people wonder about the future of office because we're working from home, and retail, of course, devastated. What's your thinking on valuation there?
The COVID's accelerated a lot of trends. People have commented on us having, leapt forward 5 years or 10 years in terms of the online shopping phenomena. It was here 12 months ago, but it's jumped forward. Retail real estate was facing some serious headwinds 12 months ago, and that I think those have only gotten stronger. And I don't see them reversing. And so that's an asset class that I think, you need to handle with care and really work through. Office space, I think, is the one that people don't yet have an answer to. We're all struggling with what we do in our own offices. I think the longer this goes on, the longer work patterns do change, norms change. I personally have way more of an open mind about working from home than I would have 12 months ago, 18 months ago.
Yeah.
I don't think the office disappears for the vast majority of organizations. I think it gets used differently. I think people think about the office differently, why they're there. They're not there because they're there every single day from Monday to Friday. And I think, it probably does mean net less office, and that's obviously not good for the office market, but I don't think it's anywhere near as challenged as retail real estate.
And on that front, would you put new dollars to work in anything related to retail? I'm thinking particularly a lot of people own REITs, real estate investment trusts that in part or entirely rely on the retail market being strong. We got a big question mark over when normal comes back for that sector.
Yeah, we personally are not trying to add to our retail real estate portfolio. We're looking to build up our office, particularly our office outside of Canada and in key markets, looking to build logistics, which is almost the other side of the what's happening to retail. It's very strong, and looking to build an own multi-res. So adding all of those, but not adding to retail.
Somebody watching wants to know what you tell Canadians who are worried about their pensions, their retirement futures. And I think we can put that into a couple of buckets, not least one. I think this is less true in Canada than it might be in parts of the US. But one potential scenario is there isn't enough money in the kitty and future retirees don't get what they were promised. In other words, the bargains are being made that will not be kept. I know that's a dire scenario, but when people are worried, what do you tell them?
I think the Canadian pension, public pension industry is, one of the things we can all be proud of. We have a model that other people look to of, independent governance, meaning no government interference, but also really realistic goals around the return expectations. And professional management of those funds. And so I think we are in a position vastly different than many of the public funds in the US, where I think that's a real and legitimate concern. But here I think we actually got our house in order.
Not necessarily, though, our federal house. I'm curious for your views on the level of deficits that the country is now running and where that might take us. And I'll say that in the context of I have yet to find more than a couple of people, Bert, willing to say anything other than, we needed to do it. We're still in an emergency. One day we need to think about balance, but it's not now. And so you feel kind of cranky for saying, why not now? Why not start thinking about the future right now?
Well, I don't want to make you cranky. So, but, I do think everything they said is right. They needed to do it. They didn't have a choice. They acted quickly, and they deserve to be commended for that. I'm not a big believer that all spending is warranted. I think I'm not a believer in modern monetary theory. All the money we're borrowing is going to need to be paid back. Even if interest rates are low, future generations are going to have to pay this money back. And so I think we do need to be careful. I think we should be prioritizing spending on areas where people are disproportionately affected. If you're asking an industry and people in it to stay home, and we can work remotely as we are, I think there've got to be supports for them. I think we have to put every investment the government makes through the same lens we would have previously, which is, does this ultimately generate more returns than the money spent? Is it a productive investment? I don't think governments should get a free pass today to spend on anything. Mm-hmm. And I also think the public policy response has got to be as focused on keeping the economy open as it is on spending to deal with the disruption, and that means a concerted effort around testing and tracing and and making sure that people can work, so that we don't need to borrow.
Are you confident that that the Canadian economy gets back to where it was? And now we should note, of course, it's easy to forget that where it wasn't that great. We were slowing down at the end of 2019 already. But, in that kind of 2% zone of growth that we've become accustomed to in the last few decades, is that in our future?
Yeah, I don't think it's in our near-term future. I do think it's going to take us at least until the end of next year to get back to where we were at the start of all this, at the end of 2019. I think there will be lasting damage. You can't turn an economy off or shut down a business for a period of time and expect it to come back. Some businesses will be lost through this, and there will be real lasting damage. So as I say, I think we're in a serious recession, and it will take at least until the end of next year for us to get our way back to where we were previously.
One of the things that happens in a recession, a natural occurrence, of course, is that jobs get lost, businesses downsize, some businesses fail altogether. And in a normal recession, the government isn't standing by to say, none of this should be happening and we're going to stop it from happening. So one of the dangers we face here, of course, is that the capital reallocation, the efficiency of markets, all of this stuff that helps us make, close businesses that shouldn't have been open and restart businesses that are great, is being kind of papered over. Should we be worried at all about that? Because will there be a big reckoning when the government does have to, at some point, withdraw all this stimulus?
Yes, I think that's a really good question. And I think the answer is yes. You do need to worry when the market mechanism is removed, capital is allocated in a really efficient way. Howard Marks from Oaktree said at some point in the last 6 months, capitalism without bankruptcies is like Catholicism without hell. It requires the ability of businesses to go under and for new ones to start. And if the government, as you say, smooths all of that over, it can keep everything going, but it's a pretty inefficient, economy, which is why I think there needs to be that real concerted effort on not just dealing with the pain points, but trying to allow people to get back to business and back to work. And if the business is ultimately not viable, it's not closed because of a public health response. It closes for substantive business reasons.
So what if you were advising the government, and maybe they are smart enough to be asking people like you what the path should be? What's the kind of withdrawal of support that will be painful for some? I mean, there's no question, because we're going from kind of a universal guaranteed benefit to you might be on your own. If you don't have savings, now is the time when you feel the pain of that. The reality check that we get in recessions, what would be the right time for a government? And I say that again, we may be heading deep into a second wave and mini lockdowns, and who knows what's happening with the pandemic. So maybe not now, but at what point does that messaging happen?
I do view this government support for individuals and businesses being pretty linked to the measures that the government's imposing on freedom of economic activity and employment. And I think it's hard to remove those supports if you're closing down someone's business. And so the two things should be absolutely linked. As you get businesses open, as you get a robust testing and tracing, and ideally vaccine or cure, but short of that, testing, tracing, allowing the market, the economy to work, then I think you can start to withdraw those supports. But until you do, if your business is being shut down by the government, it doesn't, they shouldn't be putting viable long-term businesses out of businesses. They're going to need to support the people there.
One of the things that the Canadian Club always does at the luncheon, of course, is have students in the room. And I hope that continues with these online formats. But for students, for young people who are watching all of this, who are facing massive disruption in the what might have been category of their own lives, what's your message to them about what they should be thinking about, and whether they should be feeling gloomy about the future or optimistic?
Gosh, it is very tough to watch people coming out of university and entering this kind of a job market. I'd say other people have graduated into tough markets, the early 2000s recessions, and to take a things will work out in the end. And this is, a tough thing to be happening to you early in your career, but to stick at it, and, careers are very, very long.
They are. And of course, one thing we do, we human beings do well is adapt. When you think of what Canada has at its disposal, including our highly educated workforce and a fair amount of government support of different kinds, including healthcare and education, do you think we will adapt in a way that will position us well? We are an energy-heavy, resource-dependent nation in a world that is pivoting away from that. What does our future look like?
I'm still very bullish on Canada. I think, if you went around the world and looked at, what do people look for when they're making an investment, a stable political system, the rule of law, a very educated population, urban, not a lot of internal political, tribalism we see someplace else. Canada sort of scores 10 out of 10 on almost every score. There is the concerns around the long-term viability of certain energy projects is real, but I think we are an innovative bunch, and I see us getting beyond that.
So the tribalism that you refer to, those of us who watch the markets daily, we know that the uncertainty leading up to that November election in the U.S., and Lord knows if it's, of course, settled on the 3rd or not, however long it takes. What's your thinking around, what implications for Canada? I mean, I know there's a certain amount of it that's just theater for us, but there's some super serious ramifications of that place being destabilized, first of all, and of course, who's in the White House after November.
Yeah, I think like a lot of Canadians, I find it's sad to watch the degree of division and tribalism in the United States. I think I try and keep in mind that, America's always been a pretty volatile society. We separated peacefully from the UK and built a constitution around peace, order, and good government, which, captures a lot of the Canadian way. They had a revolution, they had a civil war, they've had presidents assassinated, impeached, and so it's just a much more volatile society. I'm still a long-term believer in the U.S. economy. I think the U.S. does progress as a society, as Churchill said. They always do the right thing, but only after having tried everything else. And I hope some of what we're seeing today is just part of that. I also think, frankly, the world does need the U.S. The U.S. is the largest democratic capitalist society, and while they don't always walk their ideals, they're a powerful voice for those ideals, and we need American leadership. So
do you think will you change your investing strategy at all based on the outcome?
No, we're long-term investors, and I'm still a big believer in the U.S. and the U.S. economy. To say that every 10 years the U.S. stumbles and they dust themselves off and they get back at it, and we are still big believers in the U.S. as a market and an investment location.
And then I guess a place I'd like to end with you is, there's a lot of sort of guesswork around the outcome, how COVID-19 resolves. One of the places people are pinning a lot of hopes is on a vaccine of some sort. What's your thinking about this? I mean, when you think about the future and kind of charting a path through all this uncertainty, what's the timeline you're giving and how you think it all shakes out?
Everything I hear is that, the best case scenario is that there is some sort of a vaccine by the end of the year. That's a best case scenario. And that from there, there's it will take quite a bit of time to make sure that everybody's vaccinated, and so you're well into next year before there's an effective vaccine that everybody's received. And so mentally, that is how I'm planning around this. And you have to assume that we'll be living in a in an odd world for some time to come. Bert,
it's great to have this time with you and to get your insights. Really appreciate it. This is where I would pause for audience applause, but you're just going to have mine. That's Bert Clark, President and CEO of IMCO, IMCO. Anita, over to you.
Thank you. Thank you, Bert and Amanda, for a fantastic discussion today. I did hear some notes of optimism, and even while portfolios have become riskier over time, clearly, and everybody chases yield. Bert, if you do figure out how to de-risk and keep the same returns, please come back and share. We'll have you right on. We do hope that you'll join us for some of our upcoming events. Next Friday, October 16th, we'll host the Honorable Jeff Urich, Minister of the Environment, Conservation and Parks, for a discussion on environmental protections in the time of COVID. We hope you'll join us. Thank you to our AV sponsor, Van Valkenburg Communications, and LiveMeeting.ca for making it possible for us to come together virtually today. Guests, thank you for joining us. Stay healthy and stay safe.